Management Accounting 15A, Variable versus Absorption Costing. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, our email address, and our phone number. I recently did a problem with a student that I wanted to put up regarding variable versus absorption. It's an issue that's confusing, and I think this problem was a good one because it addresses how, over the long term, variable and absorption lead to the same profits, costs, and the revenue is also the same. So let's go through this example. First of all, what's the difference between the two? The only difference is how fixed manufacturing costs are treated. That's the only difference. Under absorption costing, fixed manufacturing costs get attached to the inventory. So let's say that it's you have a fixed repair contract to repair machinery. In fact, let's put that as our example. You have a repair contract with machines at your factory. It's fixed. It's a manufacturing expense because it deals with your machines. And finally, it's an indirect cost. It's not a direct cost, put it that way. Absorption says we're going to take those costs and we're going to attach them to the inventory by somehow applying costs. So as a result, we don't recognize the fixed manufacturing cost in absorption until the inventory item is sold. With variable costing, we immediately expense the fixed manufacturing cost. And the student was given a problem in which there are 2,500 units sold, but there are 3,000 units produced. 3,000 units produced. So I'm going to put underneath here 3,000 units produced. So as a result, we don't sell everything that we produce, so we end up with ending inventory. So we have sales, variable cost. This data is the same for both. The only difference is down in selling and admin costs are the same for both. The only difference is in fixed manufacturing costs. Here's the difference. With variable costing, we expense the entire $21,000 that was spent. With absorption costing, $17,500 is incurred right now, which is the $7 per unit cost multiplied by 2,500 units. 3,500 units is deferred. The total cost of $21,000 less the $17,500 that we recognize right now. $3,500 is deferred. $3,500 goes into ending inventory, which is the same thing as, for the 3,500, is equal to $7 a unit times 500 units. Fix it myself. 7 units times 500 units. There's my $3,500 that is a deferred cost under absorption costing. It's deferred until we sell the units. And I'm going to get rid of this check figure and this difference here. We don't need that. But I've got a couple of notes at the bottom where I say under absorption costing, then okay, that's a net income check figure. I want to get rid of that. But I do want to get to the other note, which was under variable costing, the fixed manufacturing overhead is a period cost, not a part of cost of sales. So the fixed manufacturing for variable costs, the amount's not important, is a period cost, which means we incur it with the passage of time. A period cost, we incur it with the passage of time. We immediately expense all the costs because some time has passed. It's not part of cost of sales. If it was, it would first get deferred into inventory, then it becomes an expense when we sell the item, which we'll see in a minute. Let's go down to year 2. In this year, we sell the extra 500 units from year one. Here's our sales, and those sales include the 500 units produced in year one and sold in year two. Just like above, sales and variable costs are the same for both problems. Selling and admin of 10,000 is the same for both problems. The only difference is fixed manufacturing costs, and again we have the same per unit cost of $7. Variable costing, we expense everything, 21,000. Since we sold everything we produced, and let's copy that fact down, we produced 2,000 units. Since we sold everything we produced, absorption costing says expense the 21,000. But in this case, we sold 2,500, we only produced 2,000, the difference being the 500 units that got coming off the shelf that were in ending inventory. So that $3,500 that was deferred in year one into ending inventory under absorption costing now becomes an additional cost of sales, $3,500. So if you look at the net income in year one, absorption costing had higher net income by $3,500 because they were deferring $3,500 of fixed manufacturing cost. In year two, I can get it all on the same screen here, absorption costing had net income of $3,500 less because we had the additional cost of sales from the units in ending inventory that are now sold in year two. But look what happens in total. Income from both years under absorption is 17,000 and under variable is 17,000. They're the same. Sales revenue is the same both years. I think that's not germane to this question. And in fact, the total costs in both years are the same, 108,000. If I add them up, there's absorption. And here's variable. We can look at those totals in blue and green. And since these totals are the same, the net income is the same for both years. I just reconciled the two right here by saying sales revenue minus total costs, 17,000, and I do the same thing here, so we have linked cells. And the question is why? And the answer is over both years, all inventory produced is eventually sold. Nothing's in ending inventory after year two, so therefore net income, revenue, costs are the same. That's as far as we're going to get on 15A. For more videos that are not on the web, you can go to our web page that lists videos by topic. You can access either the spreadsheet templates or the videos themselves. Our YouTube channel, Ken Boyd STL, you can email for a complete list of videos on YouTube. For one-on-one live tutoring and chat sessions, stltest.net is the website. Here's our email and our phone. Thanks very much, and we'll see you next time.